Sometimes the most boring stocks that you may not have heard of have some really strong gains, making it a consideration for your own portfolio. Today we are focusing on MLI Mueller Industries, which is up 37% just over the last 12 months. Now typically on the channel we are going to do our deep dive. We're going to look at the free cash flow growth, the sales growth, ROIC. We're going to look at an in-depth number, the top line revenue which has been increasing, as well as their bottom line net income. We ultimately want to understand what is the health of this company, their cash versus their total debt. Quick spoiler alert, it is looking very strong, but we also want to understand what are insiders doing. Are they continuing to sell? Do we have any insider buying? As well as institutions, what exactly does their progression look like over the last few quarters? And as always, we do want to take a look at their latest investor presentation and really understand, one, what does this company do for those that are maybe new or unfamiliar, and two, what are the numbers looking like, the progression in the margins, as well as others like the free cash flow. And ultimately, we do want to run it through the valuation model, getting to our intrinsic value, as well as our acceptable buy price given our investor margin of safety, and find out what do Wall Street forecast for this over the next 12 months. Now today we are going to do a little bit different. We will start off with the investor presentation, as it may be an unfamiliar company, and in all honesty I've looked at a ton of investor presentations and this does seem to be one of my favorites. It does have a lot of useful information which I did find quite interesting. First thing to note, now this is a boring company. We won't go into too much of the detail of what they do. It is in the building sector and we can see they are in the number 1 or 2, so effectively the top 2 in their products, as well as in the key markets as well. So this is a global company. You probably will have heard of them if you are in this industry. And when we take a look at what they effectively do, they manufacture products that are necessary, in their words, in everyday life. We can see, looking at transport, sports, military, pools and spas, oxygen delivery. So they are across the board. In fact, there isn't one area that you can probably think of that they don't have some impact on themselves. On top of that, they have 3 reporting segments. So as we said, fairly boring: piping systems, industrial metals, as well as climate. And we can see they do have some very nice operating margins across them. In fact, on the piping systems, 24%, and on the climate products, around 34.3%. So these are quite strong operating margins in my opinion. And again, fairly boring products, not something that maybe you would see on a day-to-day basis, again, unless this is the industry that you do work in. In terms of their exposure, well, as we said, global company, although we do know 75% of their sales do come from the US. We have around 10% of their second largest segment in Canada. We then have EMEA at 8% and some in Asia as well as Mexico. And as we said, the majority, if not everything, is under that building sector. Construction and plumbing around 46%, HVAC around 31%, and again, a few others that we can see here making single digits. Now, when we take a look at the numbers, as always, what do we want to see on this channel? 2 things. We want to see increases to their top line, and we want to see increases to their margin. So what we find, their net sales over the last 6 years, it has been increasing, although inconsistently, 2.5 billion to 3.2, although we do note the latest year is in fact lower than the 2 previous years. Margins, well, very nice to note. They have been increasing their gross margin year on year. Love to see this efficiency. And in terms of their operating performance, in fact, their operating income has again increased. We do see a lot of increases over the longer term, but we do also see some inconsistencies on a year-to-year basis as well. Earnings per share, again, a very similar theme. Increases over the last 6 years, but again, inconsistency with, in fact, lowering from 2021. Now, as always, we will look at this over the last 10 years as well as percentage form. What I quite liked about this investor slide was that they do talk about the different economic cycles and how effectively they can have strong numbers throughout. So we have the recessionary period of 01 as well as 08-09. Yes, we can in fact see the EPS did drop, but what we are seeing here is that it has rebounded every single year to go on either higher. And again, we can see even during COVID and the global pandemic, it was just another year for this company and their EPS numbers. So looking strong again through those different periods, these economic cycles that we will continue to see over the next 10, 20, 30 years and beyond. When we take a look at their cash flow, again, very similar story here. When we do look at these recessionary periods, which they have highlighted in red, again, they continue to rebound. And again, even in that COVID year, it didn't affect them business as usual. Now, one thing I didn't see from this investor slide was any forward guidance, but what we can see, how their latest quarter did perform just on a quarter by quarter basis. Last quarter, Q1 2024, 850, higher than the previous quarter, but lower than Q1. So you could argue some seasonality here with this business. Gross margin, although we see an increase on the full year, which is always great to see, on a quarter by quarter basis, we do see some inconsistency, which also leads into both operating performance as well as their diluted earnings per share. Now let's talk about the numbers. What we can then move on to is essentially the insider ownership. So we see 2.8% insider ownership, around 12 million worth of sales over the last 12 months, with 4 different insiders selling, and we can see from the red highlighted pretty much a sale by insiders every single quarter. So this isn't something that is unfamiliar with this company. It isn't something we should be shocked about. 3.51 million worth of sales in the more recent quarter as well. When we take a look to see who these insiders were, well, we in fact have the director Elizabeth D on the 30th of May selling 2,000 shares, as we can see here, $115,000. The more recent largest sell was by the CFO Jeffrey Martin on the 26th of April, and we can see for $3 million. The price around $57, which is marginally higher than the current trading price, as we can see here, $55.14. So whether or not you do believe that this is a bearish signal, for me, they do sell. Insiders will continue to sell. It was a theme we have seen over the last few years with this company. Personal financial reasons, I wouldn't necessarily call it a bearish indicator. Institutional ownership pretty high in comparison to others on the channel, 94.5%, 226 million worth of sales by the institutions over the last 12 months. A lot more buying, 1.4 billion to be exact over the same period. Majority of this Q4, so 1.3 billion buys, as we can see, very large, and what we note, very minimal sales, 1.91 million. But interestingly, in fact, even though institutions have been buying more over the last 12 months, more recent quarter, they have been selling more, 90 million versus 30 million buys. As always, very key to understand, always do your own due diligence, never copy insiders, never copy institutions, but again, we do like to add it as one layer of essentially our investment piece. Now also, just to let you know, we have released our latest free weekly article. Another article is dropping in the next few hours. If you do want to grab a copy of any of these, they are all completely free as well. Instant access. Do click on that pinned comment below. For example, you want to see what screeners we use to identify high quality stocks, read this article, or one of our more latest pieces on 12 undervalued high quality dividend stocks. Completely free, as we mentioned, and instant access. So now let's take a look at the numbers. What we can in fact see over the last year, it is up 37%. Over the last 10 years, up more than 307%. Bear in mind, if you are reinvesting the dividends, you would be up slightly higher. It is trading towards the upper end of the 52-week range. We do also want to point out we have a triple hold rating from every single analyst. Forward yield 1.45%. In terms of the P on a forward basis, 12.25. Now we do like to say that the S&P is around 22.5, but in reality, what we will take a look at later on in the episode is the sector PE comparison, which gives us a lot more information. But in terms of the top line growth, going back to over the last 10 years, 3 to 7% as a minimum baseline, 2.4 billion in 2014. Now 3.4 billion in the latest year. One thing before we look at it graphically, we can already see that this is a decline from the previous year of 4 billion. And when we do take a look at it over the longer term, you could argue some cyclicality. And when we did in fact look at the quarter by quarter, they do also have some seasonality. Effectively, some quarters year on year do perform better than others. Now, when we take a look at their bottom line, what we can in fact see here is that it has increased very strongly from 102 million to 603 million. Again, similar story. Previous year, higher revenue and higher bottom line. And when we do take a look at it graphically, their bottom line didn't really move for a large portion of time from 2014 to 2020. Since 2020, though, we can see it has been increasing. But again, we do want to point out that drop from 22 to 23. So inconsistencies across the board. No real red flag indicators that we have seen just yet, but there are just some key inconsistencies we want to point out. In terms of the health of the company, well, total cash versus total debt, 352 million sitting on the balance sheet in cash and short-term investments in 2014, just around 1.5 $1.4 billion in that latest quarterly report. Again, in reality, even when we do take a look at it graphically, it has increased over longer term, but this number doesn't really mean anything. We need to look at it in essentially comparison with the total debt numerically and directionally. And what we can see, and what I'd love to see, 242 million on that balance sheet total debt. When we take a look, they've been paying off a lot of that debt. It only sits at 34 million right now, and we can see over the longer term that total debt has reduced. So that is great. That shows us a very strong balance sheet, what we do love to see. And when we do come to that net debt to EBITDA, we will identify that this company won't even take them one day to pay off all of their debt net of cash on hand. Now, in terms of historically how have their earnings been, well, 4 for 4, we love to see that. They have beaten analyst targets, a 100% track record, and by quite some numbers as well, so that is a very positive sign. Although what we do want to point out, moving forwards for the next 3 quarters, they are anticipating negative growth year on year to the EPS. You have to go to the 4th quarter, Q1 of 25 to see growth. And if you do want to take a look far out into 2025 with their earnings per share estimates, again, forward P expected to be around 11.61. But great to see. In fact, they have been analyst targets over the last 4 quarters. We then like to move on to some gradings. The first one, the valuation. They did get a B. Now, one of the reasons for this, we can see the MLI, their P on a non-GAAP basis, 12.25. Lower than the sector median, 18.61, so they are trading at a discount of 34%. Just bear in mind, even if they are trading at a discount, it could be warranted. Maybe some of their other metrics are poor in comparison. Just something to keep in mind as we run through these numbers. Although what we can see, for example, if you want to look at a price to sales forward looking, they are trading slightly higher than the sector median. Again, will really depend on which metrics you do like to use for valuation, but as always, this is just one part of the wider picture. We then move on to the growth grade, so they get a D. Now we can start to understand why the valuation is lower. Year-on-year growth, well, negative 16%, with the sector median mid-single digit growth. Forward-looking, negative 1%, again, mid-single digit growth expected for the sector. And that is something just to bear in mind. Again, some other growth metrics here as well, but always factor in that whether companies are trading at a high or low P, it is all subjective, and you do need to understand, one, why the reasons could potentially be, and whether or not you believe this is correct and should factor this into possibly your margin of safety. Profitability grade, they get an A, so nice to see. Gross profit margin, though, it is lower than the sector median by a few percentage points. However, bottom line, very strong, 17% when the sector as a whole is at 6%. And what we also quite like to see is that cash from operations, which is 735 million. Again, more than double the sector median at 328. So overall then, for this part of the analysis, a triple hold from every single analyst, B on valuation, D on the growth, with an A on profitability. So let's take a look and see how they compare against others in the industrials industry. We have Watts Water Technologies, SPX Technologies, Flowserve, as well as a few others. What we can see here is they are one of the best over the last 12 months. They are up 39% if you have been reinvesting those dividends. Over the last 5 years, up 318. Again, one of the best as well in the industry. Over the last 10 years, again, very similar. So if you are looking for a company in this boring industry, again, very strong, 365%. So hopefully when we do come to the valuation, if it does look to be good, then this could be one for serious consideration. Now, as always, let's compare it to the S&P. Ultimately, if it isn't beating the S&P and you don't believe it will over the next 10 years, why even bother with picking an individual stock like MLI? So over the last 12 months, as we can see, they have outperformed the S&P, 39% versus 25%. Over the last 5 years, significant outperformance, 318% versus 89%. And over the last 10 years, we can see the very same story being told. So this has historically outperformed the S&P. Although what we can see from the blue line looking below, there have been times over the last 10 years where the S&P has outperformed as well. But over the longer term, this one has historically done that. Just bear in mind though, previous performance, nothing to signify future performance, so do bear that in mind. Don't expect them to produce the same result. It could be a lot worse, although it could be in fact a lot better. Now typically on this company, we do look at dividend safety. We don't have a score yet for MLI, so we can have a look at the supporting metrics. Market cap just over 6 billion. It is a mid-cap company. And something we love to rave on about, double-digit increase last year, double-digit increase over the last 5 years, double-digit increase over the last 10 years, an incredible dividend growth company. So that is already a very positive sign. And when we like to look at the free cash flow payout, it is very important for us on this channel because the earnings is susceptible to manipulation by management through accounting. Free cash flow does also show us potential dividend cuts, and we do want to see 60% or lower. As always, this does give us faith they can continue to offer double-digit increases. And if we do ignore 2017 for now, as that was a year where they had negative free cash flow, over the last 10 years, pretty much below 20% year on year. 2022, 8%, 2023, 10%. It is very obvious to see why this company can continue to offer some incredible dividend increases year on year. Free cash flow per share, as always, we do want to see consistent increases over the longer term. Now, they're not very consistent, as we can clearly see, but they are increasing nonetheless, which is a great sign. We do want to point out on a trailing 12-month basis, it has lowered, so the expectation is for the next full year, free cash flow will be marginally lower. Now here comes the cyclicality element. 5 of the last 10 years have been negative growth, and we do see a mammoth of a year in 2021. So just something to bear in mind with cyclical companies. They won't have that increasing trend over the longer term. Some years very strong, some years not as strong, and we can see this theme over the total sales. However, what is nice to note, when you do look at it from a 10-year period, the top line has increased. Shares outstanding, nothing really to talk about. While we love excess cash return to shareholders, there is very trivial amounts of movements going on there, so we won't talk about that. ROIC, 10% or more, give us faith management are able to effectively allocate their capital. We can clearly see that, and it is increasing as well. 31% in 2023, absolutely incredible, incredibly attractive as well for those that are considering adding. Operating margin, now we did see this earlier, we love to see operational efficiency, which we can clearly see here. 16% or more, which is what we get over the last 3 years. Hopefully they can continue to increase this over the longer term, as that is a deadly combination with an increase to their top line. Free cash flow margin, 5% or higher. We get to see that nearly every single year. Last 2 years looking very strong as well. And finally, we move on to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. We want to see below 3. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. As we said when we looked at the balance sheet, 2023, not even 1 day to pay off all of their debt net of cash on hand. The same to be said for the trailing 12 months. So this company does have a very strong balance sheet, and they are increasing their dividend at a very rapid rate. No surprise at all, given their free cash flow payout pretty much consistently below 20%. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's jump into the first model, Graham's valuation. We have the stock ticker symbol, the EPS, long-term growth rate, AAA corporate bond yield, and we get an intrinsic value here showing undervaluation. Bear in mind though, this is the first model we are starting off with, and as always, we don't look at any of these in isolation. The multiple valuation model, this is the second model. We're not going to use it today, but we will show you the numbers. Main reason why is that MLI is trading at a significantly lower forward PE. Now when we do compare it, we can see the PE of others in the sector. Average PE multiplied by the EPS of MLI, that would give an intrinsic value of nearly $100, so double the current market value. Whether or not you want to include it, that is why we have shown it to be transparent, but we are not going to include it today as it is trading significantly lower. It is up to you then to decide whether or not that is warranted and justified. We then move on to the dividend discount model. We have the latest dividend. Now we did see 25% increase over the last 5 years. We've gone 6.75%, a lot more conservative, and we do see another undervaluation signal. We then move on to the DCF model, free cash flow year on year, average growth 66%. Now we have gone incredibly conservative in our opinion at -4%. We are anticipating a drop just over the next 12 months, but we have gone for this again to be conservative in our estimation. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divided by the shares outstanding, a third undervaluation signal, but again, if you include the multiples, it will be 4 for 4. So in today's episode, let's get straight to it. The intrinsic value then is the average of these three of just over $70. Bear in mind, you can grab a copy of this model to run your own numbers through, whether you believe these are too conservative, too optimistic, or if you just want to run your own numbers through on another company, that in your portfolio, or that in your watch list. So let's start off with a margin of safety of 10%. As always, we execute on this if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for today's episode, it is a buy at $63.44, and then we keep going till it's near the current trading price. And in today's episode, it isn't at a 25% MOS level yet, but it is at 20% up to around $56. Now, as always, these numbers are all purely based on the estimates and judgments that we have gone through, so we do see a 20% margin of safety for this boring company with some very strong gains historically. Now, in terms of Wall Street and their price forecast, interestingly, they do see 0% upside over the next 12 months. They do consider this pretty much trading at its value. Now, the only thing we would say here is with Wall Street, it is very typical for them that if this share price continues to increase like it has done over the last 12 months, they will revise their price targets and they will make it go up higher. But again, the same is to be said. If the share price does start to drop, they will then lower their price target. So take that information with a pinch of salt and always do your own due diligence. As always though, do let us know your thoughts in the comments below. Is this one you're looking to buy, maybe looking to sell, or maybe now it is on your watch list? If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.